You don't get too many chances to study a high-quality compounder sitting near its 52-week low. But today, that's exactly what we're looking at. So this is a stock that's been quietly compounding for years, and lately, it's become one of the more talked about names inside our Piranha Profits research team. So today's video will contain a small teaser from our internal research. The company we're talking about is Copart, a business that many of you might not have heard of, despite them playing a critical role in the massive global market. So at around $48 per share today, it's down roughly 25% from its recent peak of $64, and it's currently hovering near its 52-week low. And in this video, we'll break it all down. Now, let's first talk about what Copart actually do as a business. The simplest way to think about this is that Copart is basically the eBay for damaged cars. Whenever a vehicle gets wrecked, stolen and recovered, or simply just unwanted, insurance companies, dealers, and vehicle owners will send these to Copart's storage yards. And from there, Copart handles almost everything. They clean the cars up, they photograph them, they process the legal paperwork, and run online auctions through their proprietary platform called VB3, or Virtual Bidding version 3. And these auctions aren't just local. They actually attract bidders from over 190 countries, ranging from dismantlers, rebuilders, car dealers, to even exporters who are looking to buy salvage vehicles and spare parts to resell in global markets. And before we dive deeper into this Copart story, don't forget to help us smash that like button right below. It's just one quick tap and you'll make my day. And also, if you want to get these kinds of sharings, make sure to subscribe to Investing Bites. It's our free weekly email where we send you simple, bite-sized investing lessons straight to your inbox. Now, back to the video. So some investors might be wondering, how does Copart actually make money? The bulk of its revenue actually comes from service fees. And they typically act as an agent, and every time a car is sold through their auction, they collect multiple forms of fees, and they include listing fees, buyer premiums, storage charges, title processing, transportation fees, and all of these actually stack up under their services revenue line. And in a few select markets, like the UK and Germany, Copart sometimes take ownership of vehicles directly, sells them, and record these under vehicle sales revenue. But this makes up a much smaller proportion of their business. And to give you a better appreciation of this breakdown, here's how they turned up in their revenue over the past 5 years. And one thing for sure though, their top line revenue is on a very nice, healthy growth trend. So the natural question is, what makes Copart so special? Why have they been growing consistently over the years? And more importantly, why isn't every other competitors out there simply copying what they've been doing? In investing, we often call this idea a moat, a set of advantages that prevent competitors from coming in and competing away the profits. And when you actually look under the hood, Copart's moat is actually made up of multiple layers, all working together. First, it's the power of their marketplace. Today, Copart has built the largest global buyers network for salvage vehicles. Every time an insurance company sends a damaged car to Copart, it's exposed to hundreds of thousands of buyers from all over the world. And because there are so many buyers competing for every car that's being listed on the Copart's platform itself, insurers tend to get better resale prices. And naturally, when insurers with their past experiences get better prices, they will then be more incentivized to send even more cars to Copart in the future. And this creates a self-reinforcing flywheel that's very hard for new competitors to break into, especially if they don't have their own network. But it doesn't just stop there. Behind the scenes, Copart also owns a massive physical network of over 280 specialized storage yards, most of which are actually strategically located near major cities. And these yards aren't just simple empty parking lots. Many of them were acquired decades ago when land was cheaper and it's easier to secure. And today, if a competitor tried to build a similar sort of physical network infrastructure, not only would it cost billions of dollars, but they'd also run into all kinds of zoning restrictions, government regulations, environmental regulations, and a whole host of local opposition. And that gives Copart a huge advantage in terms of both cost and also their scale. And on top of all these, they have their own in-house auction technology, like their VB3 auction platform, auto bidding system, AI-powered pricing tools, and fully integrated title processing. They are extremely difficult and expensive to replicate. Even if a competitor somehow raised enough money to build the yards, they will still need years of technical expertise to match the software and operations Copart has refined over the decades. And finally, Copart has built very sticky relationships with its insurance partners. So once an insurer integrates Copart into their system or claims workflow, such as connecting their IT systems, title processing, catastrophe response plans, and towing logistics, it becomes extremely painful and also risky to switch to a new partner. Add in all the value-added services Copart has been providing, from towing to recycling, and you're looking at a full-service solution that's deeply embedded into the insurance industry's daily operations. So the level of integration that we're seeing here makes Copart not just a vendor, but a long-term partner that insurers actually rely on. And here's the best thing. We can actually see Copart's moat working in real time. Over the years, they have been steadily stealing market share away from competitors like IAA, simply because insurers consistently get better sale proceeds. And even as Copart expands internationally, their operating margins have stayed strong, which tells you they're scaling very efficiently without sacrificing short-term profitability. And judging from their numbers, Copart's return on invested capital, one of the highly raved ROIC metric, has stayed above 15% for more than a decade, all while maintaining a rock-solid balance sheet with essentially no net debt. So when you put all these pieces together, you'll start to see why this business is so hard to disrupt. And if you really enjoyed this kind of breakdown, where we really study the nuances that shape the stock market and specific business breakdowns, that's what we try to do every week inside our free newsletter called Investing Bites. So every issue is designed to give you a short, real-world example that helps you build a better investing framework. So if that sounds like something up your alley, hit the link in the description below and we'll send the latest issue straight to your inbox. So regarding the business of Copart, some of you might be wondering, if the business is so strong, so competitive, why on earth is the stock down? And the short answer, investors have flagged out a few concerns in their latest quarterly earnings, and hence they sell first and think later. So what are some of these concerns? First, even though Copart delivered another solid quarter, revenue up 7.5% year-on-year, with their core services revenue growing 9.3%, expenses have also been rising at an even faster pace. Operating expense actually jumped 10% year-on-year as the company continues to invest aggressively into their expansion plans. They're intending to acquire more land, they are building out its real estate footprint internationally, and also they are integrating its heavy equipment auction platform Purple Wave. So while these investments are important for Copart's long-term growth, the higher near-term spending has actually squeezed their margins, and that naturally raised some short-term concerns. Second, there's been some notable softness outside of the United States. So while their domestic sales remain strong, I think international vehicle sales actually declined by 25% over the past quarter. So the international volatility adds another layer of uncertainty as Copart tries to scale globally. Third, it's this new wave of electric vehicles. So on one hand, electric vehicles, or EV for short, actually creates more opportunities for Copart because EVs are more complex and expensive to repair. So more likely than not, insurers will probably declare them as total losses, adding more vehicles into Copart's auction system. In response, Copart has also been proactively investing into specialized equipments, yard capacity, and staff training to safely process and to recycle EVs, even down to the battery level. But on the flip side, the transition brings many unknowns. So how fast will the EV supply flow through their ecosystem? And will regulatory or environmental rule change how these vehicles are being processed? I think investors are watching closely to see how Copart navigates this evolving landscape. Now, some investors might point out to competition as part of the prevailing bearish narrative. But frankly, that story isn't exactly new. So back in 2023, Copart's largest rival IAA was acquired in a $7.3 billion deal, creating a larger competitor on paper, but not necessarily a stronger one. So Copart remains in a far better position, debt-free, sitting on billions in liquidity, and reinventing heavily into growth. While meanwhile, that acquisition actually took on over $1 billion in debt and is now paying more than $230 million a year in interest. So in our view, while we'll keep monitoring the competitive landscape, this isn't necessarily something sitting high on our list of immediate concerns. So to bring everything full circle, I think Copart remains one of those rare businesses that has built multiple layers of competitive advantage. From its global buyer network to its real estate footprint, internal technologies, and deeply entrenched partnerships. That said, as with any companies, there are things to look out for. So the pace of expenses growth versus revenue, the international softness in vehicle sales, the overall slowdown in growth, how quickly their investments in new verticals are scale up, and of course, how the EV transition ultimately plays out. And while competitive landscape still favors Copart today, we have to acknowledge that the merger does introduce a larger, better capitalized rival into the mix. So for us, Copart is a name that remains in our radar. And it's the kind of business where the long-term fundamentals look compelling, but we are also closely watching how management executes in this new phase of expansion. So with the stock now sitting close to its 52-week low after years of strong outperformance, some investors might find this as an interesting case study. So this is CK from Piranha Profit signing off. Till next time, keep winning.